Welcome back, my friends. Things are not good at Goldman Sachs. Goldman Sachs reported second quarter earnings of $3.08 a share versus an expected $3.18 a share. The bank also posted revenue of $10.9 billion, which came in just above estimates. The company disclosed a $504 million impairment tied to Green Sky and $485 million in real estate write-downs. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Goldman Sachs missed on profit after hits from Green Sky, real estate. Goldman Sachs on Wednesday posted profit below analysts' expectations amid write-downs tied to commercial real estate and the sale of its Green Sky lending unit. Here's what the company reported. Earnings, $3.08 a share versus $3.18 a share analysts' estimate. Revenue, $10.9 billion, versus $10.84 billion analysts' estimate. Second quarter profit fell 58% to $1.22 billion, or $3.08 a share, on steep declines in trading and investment banking and losses related to Green Sky and real estate, which sapped about $3.95 from per share earnings. Revenue fell 8% to $10.9 billion. The company disclosed a $504 million impairment tied to Green Sky and $485 million in real estate write-downs. Those charges flowed through its operating expenses line, which grew 12% to $8.54 billion. Shares of the bank dropped more than 1% in pre-market trading. Goldman CEO David Solomon faces a tough environment for his most important businesses as a slump in investment banking and trading activity drags on. On top of that, Goldman had warned investors of write-downs on commercial real estate and impairments tied to its planned sale of fintech unit Green Sky. Unlike more diversified rivals, Goldman gets the majority of its revenue from volatile Wall Street activities, including trading and investment banking. That can lead to outsized returns during boom times and underperformance when markets don't cooperate. Exacerbating the situation, Solomon has spent the past few quarters retrenching from his ill-fated push into consumer banking, which has triggered expenses tied to shrinking the business. This quarter reflects continued strategic execution of our goals, Solomon said in the earnings release. I remain fully confident that continued execution will enable us to deliver on our through-the-cycle return targets and create significant value for shareholders. The bank put up a paltry 4.4% return on average tangible common shareholder equity in the quarter, a key performance metric. That is far below both its own target of at least 15% and competitors' results including JP Morgan Chase and Morgan Stanley. Trading and investment banking have been weak lately because of subdued activity and IPOs amid the Federal Reserve's interest rate increases. But rival JP Morgan posted better than expected trading and banking results last week, saying that activity improved late in the quarter, and that raised hopes that Goldman might exceed expectations. Fixed income trading revenue fell 26% to $2.71 billion, just under the $2.78 billion estimate of analysts surveyed by FactSet. Equities trading revenue was essentially unchanged from a year earlier at $2.97 billion, topping the $2.42 billion estimate. Investment banking fees fell 20% to $1.43 billion, just below the $1.49 billion estimate. Asset and wealth management revenue fell 4% to $3.05 billion as the firm booked losses in equity investments and lower incentive fees. Goldman has reportedly been in discussions to offload its Apple Card business to American Express, but it's unclear how far those talks have advanced. Goldman shares have dipped nearly 2% this year before Wednesday, compared with the approximately 18% decline of the KBW Bank Index. Other big U.S. banks posted earnings that topped analysts' expectations amid higher interest rates. JP Morgan Chase, Citigroup, Wells Fargo, Bank of America, and Morgan Stanley. So, the U.S. banking industry is basically in good financial health. But, there are problems in two particular areas where Goldman Sachs has concentrated. Investment banking is in a slump. And, commercial real estate is a very weak area. If you follow this channel, you know of other companies who are in financial trouble because of their commercial real estate portfolios. Starwood as a real estate investment fund is what is known as a REIT. For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Starwood Capital CEO Barry Sternlicht doesn't hold back on his Federal Reserve criticism. On multiple occasions he's told CNBC anchors that the central bank's aggressive interest rate hikes could soon spur a deep recession. It's easy to see why Sternlicht is so openly critical of the Fed. Starwood primarily invests in real estate, where the Fed's interest rate hikes have already caused a great deal of economic pain. Bloomberg reported that Starwood Real Estate Income Trust plans to shop more than 2,000 single-family rentals. Starwood hasn't publicly explained its motive for pulling back from the residential housing market, where its REIT owns over 3,200 single-family homes. That said, it's clear that the decision to shop these 2,000 homes comes as Starwood faces an uptick in redemption requests and endures pain in the commercial real estate sector. According to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes, bought 90% fewer homes in January and February than they did in the first 2 months of 2022. Why are institutional investors pulling back so fast from the U.S. housing market? It boils down to the fact that the financial return on each additional home added just isn't that great right now after factoring in interest rates, house prices, and rents. Not to mention, some big investors like Yield Street think that national house prices, despite jumping a bit this spring, are poised for another step down. Not only are institutional investors buying fewer homes, some are reducing their overall single-family portfolios. Look no further than Invitation Homes, the largest owner of U.S. single-family rental homes, which recently became a net seller. In the first quarter of 2023, Invitation Homes bought 194 homes while it sold off 297. A year earlier, in the first quarter of 2022, Invitation Homes, which Blackstone helped to grow before divesting in 2019, bought 822 single-family homes and sold off only 147. Invitation Homes isn't alone. American Homes 4 Rent was also a net seller in the first quarter. In the first quarter of 2023, American Homes 4 Rent sold off more single-family homes, 666, than it bought, 312. That net decline saw the Las Vegas-based company's portfolio shrink from 58,993 rental homes across the country to 58,639 homes. A year earlier, in the first quarter of 2022, American Homes 4 Rent bought 1,131 homes and only sold off 171 homes. The weakening commercial property market is another reason why private REITs including Starwood's and Blackstone Real Estate Income Trust are contending with high numbers of requests to redeem their shares. Both Blackstone and Starwood have now limited investors' withdrawals from their funds. In fact, investors are pulling their money out of these big real estate funds at a fast pace. The U.S. housing market is seeming like a speculative bubble once again. And there are probably a number of investors in the REIT that think real estate prices will further deteriorate. So, what does this mean for Blackstone? Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Commercial real estate values have fallen across the nation. The real estate funds have recently seen a surge in withdrawal requests. A spokesperson for Starwood did not return requests for comment on Friday. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BRIGHT. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.